Right, good afternoon everybody. I think last two sessions on accounting issue, financial reporting issues. Accordingly, we are planning to have kind of revision, like we did revision for what is called for the previous course in it. So we have 2 days, today and next week. So I am planning to have kind of full recall on all the areas that we have already done. Accordingly, as I can remember, I have covered all the areas given in the course content. So today we will see at least 4 or 5 areas which are important to recall our understanding relating to the examination, right? So today I am planning to discuss some important or the basic areas, like some not to discuss in detail, but just to show some important areas from these parts: accounting framework, financial instruments, employee benefit, share-based transactions. Those major 4 plus some other small areas that we have touched from IFRICs. So I am planning to keep 1 day for group accounts. Right, then next week I will do kind of revision for the group accounts. Today I will discuss some small areas, right, like other small areas as part of revision. Hope you have already studied, otherwise you will not able to get the real outcome of a revision session. If you have not studied, it is quite difficult. But anyway, I hope you have at least remember some important areas that we have already done within the semester, right? Last 3 lectures I think were conducted by Mudit. He did IFRIC 13. What else? Harmonization in accounting and fair value. Those 3 areas. Then I did human resource accounting and creative accounting. Those kind of small areas also. Accordingly, we have covered some qualitative aspects. Plus, there are 3 major areas in our syllabus. Those kind of purely qualitative contemporary accounting issues and financial reporting standards plus group accounts. Those are the 3 main areas in our syllabus. Accordingly, for the examination also, we will test those 3 areas, at least 1 or 2 questions from those small areas like human resource accounting and other things, fair value, then harmonization or convergence of IFRS and IFRICs, those areas. In addition to that, I did some accounting standards and we discussed some aspects of group accounts, very basic things on group accounts. Then in the exam also you have to cover those 3 areas as major areas. If I start now, today I am going to run through these set of slides just to show you the things that we have already discussed. Actually, I am not going to discuss in detail, but I need to show you what are the points you should know for the examination point of view. So then better to remember the areas that we discussed will come for the exam. So if you can remember, I discussed a lot of questions last time also in accounting subject, right? So in revision, most of them were there in the exam. I am unhappy because even though most of the questions are repeated with small modifications, people are not in a position to write proper answers. So it is kind of a bad scenario. So this time also anyway we do the same, we do kind of revision, and so same type of models will be repeated in the exam. So therefore you can easily guess what the exam paper is. So I think it is easy, but one side it is part of learning. You are studying, this means you are learning. So that's our focus, right? So we'll do some questions again today and next week. Out of those, few will be repeated with some small modifications. Also, you will see similar type of questions in the final exam. It means if you follow at least these 2 revisions, you will be able to pick some marks. And that's one aspect you need to remember. Also remember your exam, what is called assignment is due on tomorrow, right? So then I have increased marks up to 30%, right? So then we are not going to have online test. right? So only one assignment, 30% and 70% for the examination. Right, then paper structure wise, you will have at least 2 or 3 questions from group accounts, 1 or 2 questions from this IFRSs, including IFRS 2, IFRS 9, IAS 19, etc. And we did revenue also this time. Leasing also we did, no? Leases we did, no? Leases we didn't do. I think we did, I'm not sure exactly. Leases we didn't do this semester. Right, no worries, right? I'll check it. Accordingly, those areas are important, and you will have separate questions on group accounts, right? I don't expect to give any compulsory question, but it's kind of a 20 marks question. You will have 6 questions. Out of those 6, you have right answers for 5. Right, hope if I'm recalling your understanding from the very first lecture, we discussed about some basic understanding on what is financial reporting issue and what is contemporary accounting issue. I told you a lot of examples with a research article relating to contemporary accounting issues. I told you some governance issues, some reporting issues, all are coming under contemporary HR recognition issue, then intangible issues, goodwill issue, fair value issue, all are relating to contemporary accounting issues in accounting. But after that research article discussion, we learned that there are different areas. Some issues are very narrowed ones, some are very broader ones. There are some issues actually we have already answers in our system. There are some issues still we are discussing and debating on this, but we don't have final answer. Those are the things we recognize as contemporary accounting issues. Simple example like you have already learned fair value. People are negotiating on that, some guidance also there, but still we have some questions on that. And sometimes corporate governance. We have some corporate governance issues. Everybody is talking about improving over the period, but still it is improving. There are some gray areas. Right, so then those are we call actually contemporary accounting issues. That's the main focus in our exam, not exam, in our syllabus. But you can remember actually we discussed some other minor areas. We call actually simple accounting issues. Most of the solutions for these simple accounting issues was identified through IFRS, if you can remember. When you think about accounting standards, you have to remember about all these areas. IASs, IFRSs, IFRICs and SICs. Actually, we didn't do any SIC in this semester. So then we did some IFRICs, as I remember, transfer of asset from customers. IFRIC number 1, decommissioning charges, and IFRS 13, then non-current distribution, non-cash distribution to owners, and whether agreement contain a lease. Yeah, those are the IFRICs we did, and as IFRSs we did only 2 IFRSs and 1 IASs for the semester. Today I am going to recall you understanding about all these, just to run through these. I am sure you will not be able to understand anything today, right? Why? I am not going to explain anything. So usually I am going to cover at least 5 weeks within 3 hours. It means I need to show you these are the things there. It means you have to have kind of a structure in your mind to apply. In this level it is also important. At least if somebody is talking about, let's say, now if somebody is talking about recognition of revenue, at least you have to understand previous on IAS 18, now we need to refer IFRS 15 from next year onwards, 2018 onwards. That means at least you should know that point. If you don't know that point, how to find the content? Let's say if somebody is talking about customer loyalty programs and how to account for customer loyalty program, at least you should know it is there in IFRS 30. So then only you can find the solution. So at least if you know the point, you can say to your subordinates or your trainees or your other people in your staff, where you go and see there, it is there, you just report to me. At least to say so, what you need. You have to have basic idea. If somebody is talking about decommissioning charges of an asset, you should know that point is there. There is a separate standard on that. Accordingly, I have to report. If somebody is talking about fair value and its measurement, at least you have to understand it is relating to IFRS 13. Then you have to go there and refer. Something like that. So therefore, that kind of rough understanding also important. If you need to account for, let's say, pension fund, how to account for pension fund? You're going for, it's according to IAS 90. That kind of basic guidance will be given today, covering all the areas. That's why I said you will not be able to understand anything, but you will have kind of broad, any specific content you can't understand, but you will have kind of broad understanding what you have done within the semester. Right? So that's our focus today as revision. I hope if you can remember, in the very first lecture I did something related to those contemporary accounting issues. Thereafter we discussed some accounting issues, small areas that we need to focus. If you can remember, there I did discuss little on accounting framework as well. So therefore this semester also you need to think about accounting framework. Before that, one more point, before starting revision session, you just see the last time exam paper. At least within this revision 2 sessions, I'll discuss 2 past exam papers as well. I'm planning to discuss something from 2016 and I'm planning to take 2014 and 2014 paper and 2016 paper. So then you can have kind of rough idea also with this, what sort of questions will be tested in the exam, especially how do you write an answer to score. It is very important point. Like if I give you a question, how do you score from that? Most of the people I understood, even you have set for many exams and you have written for many exams, most of the people do not know how to score from the examination. That means they don't give proper answer directly. So therefore, look this 2016 exam paper, last time exam paper. Out of 6 questions, you had to write answers for 5. You look the first one. We will discuss some questions also here and there, right? From these papers, not all. Time we will take some questions and I'll explain answers. Especially I'll explain what we expect from a question. You have to meet that. Especially I told once, even if I give you mini case study, I'll do it later. How do you need to write an answer? It doesn't take more time. You don't want to write half a page. No need. Specifically, you have to focus on 3 areas or 4 areas which are important for a question. So therefore, remember how to score. It's an important point. Look now, first question, with the question itself, you can understand it's part of accounting framework and harmonization. Yes, so the third part relating to harmonization, first 2 parts. First on yes, very simple, general question, right? Anybody can write the answers for this kind of one. Then the second one relating to qualitative characteristics, we'll discuss it later. Then third one relating to harmonization. Explain how financial reporting framework deals with the concept of harmonization of accounting standards. Very simple. No? One of the major objectives in accounting framework also to provide common platform for all accounting standards. Right? So then in harmonization, what we learn? What is harmonization? Now you can't remember, you have to check what is harmonization, right? So that's why I said usually now you will not be able to get new thing. I am not going to do any new thing today and tomorrow, next week. I will just recall what you have learned. So that's what we call revision, right? In harmonization, what you try to do? Yes? Same type of? All? One platform. All the countries' practices into one platform. There are small differences between convergence of IFRS, internationalization, standardization, harmonization. What is harmonization? Continuous process of? Or you can say like that as well. Harmonization of accounting standards means we try to get a common platform for reporting everywhere in the world. right? So that's kind of harmonization. Actually, convergence process means we are converting local versions into international version. That's IFRS convergence. Though two different. Harmonization means it's kind of global perspective. What they try to do, they try to implement or provide common platform for reporting purpose everywhere in the world. So that's why everywhere now we can see IFRS as IFRS. And now from 2018 onwards, actually we will see another IFRS 15. Actually, I wanted to discuss with you, which is to be IFRS 15 will come in 2018. With that, you have to replace more number of standards. IAS 18 will be replaced, IAS 11 will be replaced, IFRS 15, IFRS two IFRSs will be replaced with IFRS 15 new one. It is rule based, sorry, principle based standard, new one, right? So therefore, anyway, there may be some updates in 2018, and we'll see this side first. Then question number 2 from creative accounting. Why people do creative accounting and how creative accounting practices can be controlled, something like that, and the balance part from human resource accounting. We will do these questions and answers also, right? Then question number 3 from IFRS 2, and the second part of the same is from IAS 9, employee benefit. Then question number 4 relating to revenue. Question number, there are part 2 relating to decommissioning charges, IFRS 1. Look, everything we have tested. This is from IFRS 13, third part, right? It is from, you can remember actually, customer level program. Then question number 5 is the easiest question, which is not coming this semester, right? So what do you mean by financial asset and something to write, right? And number 6 relating to group financial statements. Number 7 also relating to group financial, but very simple and small questions. I prefer, if you look at the models for 2013 and 14 exam papers, 13, 14, 15 exams rather than 2016, because this is fairly easy paper. Don't take this as model paper. Last time, actually we had several lecturers last time, therefore better to refer 2013, 14, 15 exam papers as model paper for the coming year, this year, right? I'll do those, therefore I do those questions. This is about last time exam paper. With this you can understand whether it is easy or difficult. It's happening every time off, no? Switch off. Right. Right. For the examination point of view, you need to think about the main part. I am going to cover actually here 3 main areas first. Thereafter, I'll do some questions from those to practice. Accounting framework, IFRS 9 and IAS 19 and IFRS 2. All these I am planning to cover today with questions. Already we have done a lot of questions. Therefore, I'll do some. I'll repeat those questions as well sometime. That means I am planning to do the questions we have already done again, just to practice. And there may be some new questions also. Right. Before starting the accounting issues, you should know why we need to have information to make decisions. What sort of decision information will be provided by accounting, and why do we have something called contemporary accounting issue, and what is just accounting problem or accounting issue? Why do you say something contemporary? And there are some other small accounting issues, like if you take like, let's say simple IAS 16 even. So they are also providing some solutions for small problems. IFRS 13 related to customer load program, something like that. Small accounting issues also there, macro accounting issues also there. So therefore, if you can remember, we learn why we need financial statements and some limitations of financial statements, especially in the case of IFRS. When it comes to IFRS and international convergence of financial accounting standards, there are a lot of problems, right? So those problems should be addressed in these IFRS versions. So therefore, there are different information requirements of different users. Then fair value itself, it's kind of question, and it's from your assignment, no? I gave you fair value, yes, right? And also most of the standards were developed in capital markets, and when you try to implement those in local context, there are some problems, sometimes cultural issues and perception of people, all are problems in reporting. So there are people like that. I recently noticed or heard about a story. Even all these reporting requirements are there, accounting standards are there, everything is prior set up. If you don't have right perception to implement or report, the reporting objective will not be achieved. That means if you need to recognize any reporting framework as quality reporting framework, people or the accountants perception will give kind of big contribution. If you don't have positive or good perception on accounting, the standards or what is called convergence of IFRS, you will not be able to provide good or quality information. It's another problem that we have. So those are the kind of issues that we need to see in convergence of IFRS. What has happened now? Even convergence of IFRS itself has become kind of contemporary account issue. Why? Now, what IFRS people say now, currently around 145-46 countries are using IFRS version. Right? There is another version called GAAP. It's USA version. So then out of those 146 people, some countries are developed countries, some are average, and some are very poor countries, so developing countries and underdeveloped countries. Then when they try to implement one set of IFRS across the globe, what happens? Those cultural issues, cultural barriers, people perception, country, economic situation, everything will be affected to what? To its implementation of IFRS. Fortunately now our inland revenue people, what they do, they are studying our IFRS, and they have not incorporated their system into IFRS version. So still it is partly done. I don't know whether it is fully what is called complied with IFRS version. I don't think so. So therefore it is also affecting partly for the reporting. If you have good compatible tax system and IFRS system, yes, it's good. Now we know for organizations they have a lot of problems as a result of that. So then it's also kind of impact of IFRS implementation in our country. That means we didn't have a good plan, macro level plan. So that's the reason we just implemented without incorporating other aspects which are needed to implement IFRS. We can say actually those are IFRS infrastructures. Right? To implement IFRS, what we need to have? We need to have good legal system. We need to have good legal system, means Companies Act and everything should change. Also we should have good tax system. Otherwise how can you run the accounting system? Or corporate governance, everything should be complied with the IFRS system. So therefore you have to focus on that. But it's my final message. You need to understand why standards are important, accounting standards are important, and what are the problems inherent into these accounting standards. Also when you try to convert all these local versions into IFRS version, what are the problems that we encountered. For those we have several solutions as well. One solution is do disclosures as possible as we can to sort out these problems. Also we say to sort out some problems in financial accounting or the financial reporting, we need to comply with more accounting standards as possible as we can. It is another solution to avoid those problems. Right? So then another one is the important one. That's the question actually gave last time. That's about to comply with framework. That's why there was a question there in the paper, 2016 paper. How this framework will help to do harmonization concept in the world. Accounting framework will help to mitigate most of these problems. Right? Accounting framework. So therefore we came into accounting framework and we discussed several points. I don't want to discuss it again, but we will see some of the little application of this. We learned about objectives of financial statements. These are things we learn. I don't explain one by one. And we learn about underlying accounting assumption. We got going concern as accounting assumption. And we learn thereafter qualitative characteristics of financial statements. It means to recognize any accounting information system as good information system, there should be some qualitative features. Those are the things we recognize as qualitative characteristics. There was a question from this as well. Last time I asked, what are the methods or techniques that you need to implement to comply with these qualitative characteristics. You have to say these are the qualitative characteristics and write at least one technique which you can use to keep these or retain these qualitative characteristics. We need to keep comparability. How to keep comparability? Tell me one technique. How to keep comparability in financial statements? Yeah, you provide last year information. In attachments, you can see 5-year statistical summary. Why? It is given to keep comparability. How do you keep verifiability? How do you keep verifiability? How do you verify information? Anybody? If you say at least one technique to keep verifiability of account information, how? Anybody? It helps to understandability. Ratio analysis is done to understand the business and its financial transactions. To keep verifiability, what you should do? That was a question last time. It's for I think 6 marks. Maybe. Look, what are the qualitative characteristics of account information proposed by financial reporting framework? Then you have to say those 6, very simple. You will get only point, maybe maximum of 2 marks if you write all those 6. Suggest techniques, methods, ways that can be used by an entity to comply with those characteristics in financial statements. How to protect them? How to retain them? How to keep verifiability? That's why we account on source documents. Now, important tax people, how to verify sales? Now, let's say if I provide sales as 1 million for this year to Inland Revenue in tax report, tax accounts. So, how to make sure whether I have done it correctly? You check from invoices. If you have any doubt, you call for invoices. You'll ask them to verify through invoices. Right? So then what is that? Or you have some other shortcuts to verify the sales based on VAT amount and all others. You can guess it. Even salaries you can check from EPF, ETF, sometimes statutory requirements. That's true. In addition to that, if you need to verify it 100%, you ask them to bring necessary invoices. So then what is that? Why do that? Why do account for on source documents? To keep verifiability of information. Otherwise, people will not believe this information, or people will not trust information. The others are like, for all these I told one technique, if you can remember. You just see my the lecture in maybe first or second day. I have done everything. And to keep understandability, actually we provide enough notes. All these notes and everything will be given to keep understandability and timeliness. That's why we provide actually information for a year as statutory requirement. So those things you should write as answer for this part 2 in question number 1. And thereafter we discuss about elements. Sure, you will this time also we will get some we call it case studies related to elements. I don't ask what are the elements, but you should be able to apply the understanding of elements into financial statements, right? I told a lot of examples we can remember relating to assets, how to recognize asset and all others. And recognition criteria. I remember measurability and probability. I always explain these two. Remember those. And measurement criteria and concept of capital and capital maintenance. Those are things we discuss. And also there are some positives and negatives of the accounting framework as well. So already we have discussed everything. Right. That's all about framework. When it comes to framework, you have to remember only few points. What are the points in framework? You have to remember about objectives of financial statement. You have to remember about online account assumption. It's about going concern, I told you. What is going concern? Going concern means business will run for foreseeable future, continuous business future. Right? So as a result of that, we have to take what is called periodic concept of periodicity. Even auditors, what they look mainly, they look whether we have going concern. Hope we have learned it in auditing. A separate accounting standard on going concern, and you know how to assess the going concern from auditor's point of view. Hope you have learned. Is it done? Yes, right. You can remember there were some indicators given by the standard, what indicators we call environmental or corporate level indicators, financial indicators, non-financial indicators, something like that. You had in standard, right? So those are there, right? Think on that. Anyway, now after accounting assumptions, you have to think about what is called qualitative characteristics, and remember components also there, components of financial statements, and elements of financial statements. You have to remember individually elements. Now, and finally, we discuss about recognition criteria for elements. Those are the main things in the framework. You draw your attention for those areas. Just to practice some items, already I have done all these, if you can remember. ඔක්කොම කලින් කරපුවා. Library, book, story, everything we have done already. Therefore, I don't want to do it. If you can remember, this is partly relating to decommissioning charges or demolition charges from IFRIC number 1. So this one also we have discussed already. Therefore, you just go through the videos and see. So we don't want to have more time on this. Then international convergence, and why we do convergence, or why we convert our local version into international version. So then there are some benefits. Look, those are there. Also, you may have learned with Mudit about some barriers to convert or convergence. What are the problems when you are trying to convert a local version into IFRS? Environmental and social reporting we have discussed little. These things will be very helpful in your assignment, because assignment is relating to fair value. Actually, I didn't do fair value as I remember. So you have to compare and contrast fair value against historical cost and other attributes, measurement attributes. Have done your assignment, uploaded. I checked today morning, only 10 people uploaded. Now I don't know, I didn't check afternoon. Right, anyway, it will be closed by LMS Dropbox will be closed by tomorrow, no? Tomorrow evening. Yeah, tomorrow morning, right? Morning, is it? Okay. I can remember it's afternoon. 7 a.m. is it? Is it? So no worries. If you need, I can drag it to evening 7:35. I thought it's evening. Maybe small mistake. I'll check it. No worries on that. Anyway, you don't want to wait till last minute, no? If you have done the work, you upload it. That's it. Hopefully, people have not done, because only I noticed today morning only 10 people submitted. You all have submitted? No, not yet. When? Then when do you submit it? Huh? Today? Today night? Because I was in Karma. හොඳයි. Huh? Improve. Oh, very good, very good. Do improve. No worries, right. Let's see what we can do. 30 marks, therefore you have to put enough weight on this. Right, then we discuss about these things. What is fair value and actually I didn't do that much in the class, but I gave it as part of homework. These things, why people can't fully recommend fair value, and also you need to think about why people should not ignore fair value. So sometimes fair value is not good solution, but you can't ignore even. Right? So therefore you have to analyze those aspects also. Actually you have enough materials in the internet relating to fair value, if you can see. So therefore don't copy as it is. You can read those materials, take whatever the things you need, because I also have studied those materials, therefore I also know what are the things in the internet. So therefore what people do usually, they take as it is and put into their what is called assignment. Don't do that. I know you have to refer those. Read it. Actually the idea of giving this kind of unfamiliar area is to read. When you read at least one article relating to fair value, you will be able to learn a lot. That is the intention. So otherwise, no point of giving assignments. It was changed. Huh? Otherwise, I will forget it. Shift it to evening, right? Fifth evening, no? Not AM, then it's PA. Right, we'll come back to this. Look, application of fair value. This will also be helpful in your assignment. You have to think about the application of IFRS 13, how we have used IFRS 13 in different levels and contexts. Accordingly, you can what is called explain these applications into your assignment report. Right, it is done. And secondly, we came into, if you can remember, about financial instruments. We discussed a little about financial instruments, not that much seriously, but we studied, right? So hope you can remember the few things. Definitely we will have at least 5 or 6 marks, maybe around 10 marks from financial instruments, which is important in our country now. So actually I did financial instruments IFRS 9. So then we discuss about the basic classification of financial instruments as financial asset, financial liabilities and equity instruments. Hope you can remember, right? And based on these financial instruments, thereafter we took a lot of examples. What are the financial instruments like cash, maybe even cash, financial asset. Importantly, you have to understand the application of this financial instrument standard. This is very important. You just imagine a balance sheet or statement of financial position and tell me at least what are the standards applicable for different lines in a balance sheet. After having master degree in accounting, at least you should be able to tell different lines in a balance sheet and different standards relating to those. Yes, what are those? Let's take first line. What is first line in balance sheet on the top? What sort of asset we call it? First line on the balance sheet. Non-current asset, thereafter under that What is first one? Line items equal. PB 16 and IFRIC 1. Look, there are two. Another one, next one. After PB, investment, what standard? Take line by line and see what are the applicable standards. That is minimum requirement, investments, financial instruments, right? IFRS 9 or IS 39 you can say. Then next, intangibles. Before that, in PB, lease assets 17 or IFRS 16, now new one, lease or IFRS 16 new one. And thereafter investment properties, LKS 40 or IAS 40, investment property. Then there is another, all are related to look non-current assets. Another one, SLFRS 5, non-current asset held for sale. If you classify any asset to sell immediately, non-current asset held for sale. So then you come down further. You have intangibles like intangibles LKS 38. Or sometime you will see something called group goodwill, IFRS 3, business combination. Look, a lot of assets are there now. Goodwill, if you recognize goodwill arise on business acquisition, it is IFRS 3. Or SLFRS business combination. Then you come down further. I don't know that. I said, I think. Non-current asset, right? If I am not mistaken, I took all. Yeah. Thereafter, current assets, inventory, IAS 2, trade and other receivables. What is accounting standard? Trade and other receivables, IFRS 9, financial instruments. It is coming under that. Look here, in this slide also it is there. Financial asset, trade receivable. Is there? Right? So then cash and cash equivalents. What is that? Financial instruments. Look here again, cash coming under that. Right? So then I told all asset side. When it comes to other side, the current liabilities, trade payables, financial instruments, provisions, LKS 30 or IAS 37, provisions, contingent asset and contingent liabilities. And in the case of trade liabilities, accruals, and if you have overdraft, bank overdraft, it's also part of financial instruments. Bank loan, non-current liability, financial instrument. Equity, reserves, now I am going up. Reserves, financial instruments. Share capital, financial instruments. Look, financial instruments cover most of the items there. That is final point. Most of the line items I told now, if you take IAS 2, inventory, only inventory. Most of the balance sheet items are coming under which? Under financial instruments. Therefore, this is important. Right? Most of the people do not know about it. Those are direct standards. There may be some other standards, like let's say if you need to think about revaluation reserve, it's not financial instruments purely. It comes from where? LK 16. There are some other impacts also, but mainly we need to look at this standard to recognize other areas, right? Right. Then about financial liability, I don't want to explain one by one. I'll give kind of broad understanding. That's it, right? Thereafter we'll do some. Then equity instruments. I told you about preference shares classification, whether it is part of debt or part of equity. That part also I discussed. And also another part, financial asset, financial liability, equity instruments, as well as I told you another part we call compound financial instruments or hybrid financial instruments. That means some financial instruments are having part of debt and part of equity. So then you have to think on that. Then one classification according to IAS 39 we discuss. From this we discuss financial asset at fair value through profit and loss account. So then financial asset through other comprehensive income and amortized cost. Those are the main three classifications we learn in IFRS 9 relating to financial instruments. I think I have given some videos. One video, so I have given link as I remember into the LMS relating to financial instruments, which is very important. You can see that video and you can learn about this classification and all others. Some people say this is only two classification because these two are financial fair value. Some people say only two accounting treatments relating to financial instruments. One is fair value, another one is amortized cost. In fair value there are two: fair value through profit and loss account, fair value through other comprehensive income. But only thing you should understand what do you mean by these. I explain all these with examples, enough examples. So how do you recognize this fair value through profit and loss account? I told you at the beginning we recognize it at cost excluding transactional cost, and we do some questions also today. Excluding transactional cost, and at the end of each year you remeasure it to fair value and difference should be charged profit and loss account, something like that. Then second classification, I don't do sums here now. Fair value through other comprehensive income, it means I told you all the financial instruments, especially equity instruments, initially recognized at its fair value, including transactional cost. If you can remember, we learned how to amortize transactional cost over the equity instrument period. And we remeasure at the end of each year to fair value, and difference should be charged to other comprehensive income. Right? So that's how I told you. Also, I told you at the derecognition point, or we call it at the disposal time, the other comprehensive income should be recognized as part of retained earnings, right? So that's how we learn. And then financial asset measured at amortized cost. And remember, we discussed about two types of test: business model test and cash flow characteristics test. Accordingly, if any financial instruments, most debt instruments are recognized as financial asset at amortized cost. So if you can remember, there we test for impairment at the end of each year using expected loss model. Those things we discussed. Can you remember, we valued these financial instruments based on their future expected cash flows. We'll do at least one sum today. I'm planning to do one over two sums. So look, this is the way that we have taken present value of future expected cash flows and take the fair value at the end of each year. If there is any difference, you charge to other comprehensive income, or you charge it to profit and loss account. That's how we did. When it comes to financial liabilities at fair value through profit and loss account and amortized cost, we discussed. So those are the two classifications we discussed. I'll come to questions quickly. And also another area we need to focus, probably we will get a question on this, about compound financial instruments. At least you should be able to understand how to split this debt part and equity part in a compound financial instrument. It means I told you, if you take any financial instrument, it has majorly two parts. Part is debt and part is equity. So good example is, I told you, convertible debenture. It means you can issue a debenture for a holder, and after 5 years time you don't want to pay back the debenture value. That debenture value will be converted into shares. That means convertible shares. Convertible means after a certain number of years the holder can convert those debentures into shares. In that case, those type of financial instruments should be recognized as compound or hybrid financial instruments according to IFRS 9. Right? So we learned at the beginning what we need to do. We need to separate this debt part and equity part for accounting purpose. So how do we split this debt part and equity part? First, we need to allocate the carrying amount of the liability and carrying amount of the financial instrument as part of liability, and balance part should be allocated to the equity. Can you remember we did this kind of questions? Even if you can remember this question very easy, so we need to identify what is the debt part and equity part. So here, if you can remember 200,000 3% convertible bond, that bond will be converted after how many years? At the end of the period you can convert, but it should be how many years? Ah, 2 years. 2 years convertible bond. I didn't see that term. 2 years convertible bond. Accordingly, what you have to do it? You take interest, next 2 years interest, and finally at the end of the second year, the principal amount, everything you take into present value, that should be allocated for the debt and balance part for the equity. Right? So that's how we split it into debt and equity. Can remember here also we have done the same. Look here, interest and capital repayment. Look this one. We recognize the present value of these at the rate of that and at the rate of 8%, not the 3%. 3% is interest rate. How to take 8%? Here it says effective interest rate of the instrument is 8%, but if you don't have this conversion option, rate will be 8%. In that case, you have to take the rate where you don't have that particular conversion option. Other financial instruments, similar financial instruments without having the option. So then use that rate and discount it. Accordingly, you will get this value 182,000 something. Then it is the value of liability. It means balance part is for the equity. How to account for this then? You get cash at the beginning, cash or bank debit first, 200,000, equity credit 17,000 something, and liability credit, financial liability credit 182,000 something. Right? So that's how we account for compound financial instruments. What do you think? We do questions, or straight away we discuss all theories and later do questions? What do you think? What do you prefer? I have done at least we will do at least one question from each area, at least one. Oh, what I can do, I'll explain like this all, and finally we can do all questions. Oh, we do explanations for one and do questions. Again, come back to the another one, do questions. What do you think? You will feel lazy, no? We'll do at least one question from. So I'll discuss one area and I take one question from past papers and discuss. It's good, no? Or past papers or some other questions. Yes, bye. To do past papers and model papers, anyway, you should be able to remember all this. Hope this question is given in the tute. Yeah, just see this question. We didn't do this in the class also. One more small point. Wait 1 minute. I need to show you one question. Did we discuss a question with issue cost? We did, no? How to recognize issue cost over the period and all? In these revision slides I have not included, but I am sure I did it. Can remember the convertible bond is there, then at the time of issuing there is a premium. At the time of redemption, sorry, at the time of issuing there is a discount. At the time of redemption there is a, what is called premium. There is issue cost, interest cost. Everything we amortize over the period, 8,800 something. We allocated over 4 years. That kind of question we did, no? I wanted to make sure whether you have done. I think I did. Is that? I hope we did. I am sure I did like that. 8,800 something finance cost totally. It's interest, issue cost, premium, discount, everything we amortize over the period. We did not, yes. Because that question is not there. That's why I just check whether it is there. Anyway, I have done it now. No need now, no need to do it again. Yes, it is there. It is here, right? Look, this question, it's about including everything. In this question, look, the one company is issuing 20,000 6% 4-year loan note with a discount. Discount is 10%. Then discount is 2,000. Right? Discount is 2,000 at the beginning of the year. And there is issue cost of 1,000. It is also at the beginning of the year. At the time of redemption, the company will pay a premium of 1,015. Right? Also there is interest over 4 years. Right? Look, this answer also there as I remember. Look, interest over 4 years, we have to pay 4,800. Discount at the time of issuing 2,000. Premium at the time of redemption 1,015. Issue cost at the beginning 1,000. All together 8,815. Issue cost. We charge as absolute values to profit and loss account once it is arise. But what you have to do? This 4,800 you have to write off over 4 years as 1,200 for each year as interest expense. Discount at the beginning of the year, first year. Premium in the 4th year. Issue cost in the 1st year. But we don't do so. What we need to do? We need to amortize it over 4 years time like this. Look the way that we have done. We discussed this question, therefore I don't want to discuss it again. 2,040 for the first year, 2,100 something for the second year, 2,200 something for the third year, and 2,300 for the 4th year. Look the way that we have amortized smoothly, right? Without taking those finance expenses time into profit and loss account. That kind of thing we did, right? So therefore you have to be ready for these kind of questions. Right, we'll come back to this now. Example number 3. You just take 5 minutes and see whether you can do for this, you can find the answer for this question. And thereafter, we'll have a small break for 5 minutes. I'll come back by 10 minutes. Just do this question, huh? Right, done? Finish? No? I thought you have done it. If this is difficult, you have not learned anything from this financial instruments. Is it? I told you, not like last time accounting paper. This is little technical and there are some things to learn. Right, here what it says. It's X6 issued on X6 and they are going to redeem it Y1, means 5 years exactly. 5-year bond, convertible one, par value is 50,000, sorry 50 rupees each, 5% interest. Interest will be paid annually in arrears. The prevailing market interest rate at the date, 6%. Yes, now what we need to do? We need to discount it. Take future cash flows. What are the future cash flows? 10,000 into 50 into 5%. It is interest, right? $25,000. It is interest per annum for 5 years, and at the end of the 5th year you have to redeem it without having any premium. It's for 500,000, right? So then discount it at the rate of 6%. So look, answer is there. It is not that much clear, but annual interest payment is 25,000. Look here. Then 500,000 after 5 years, you have to discount at the rate of 6%. Then discounted factor is 0.747. 500,000 into 0.747. It is 373,500. Cumulative interest I have taken here. Since this is, we'll see whether we can type at this. Can type now. So then 25,000 annually you are expected to get interest. 25,000 should be discounted at the rate of 6% again over 5 years. Then the value is 105,300. Then total is 478,800 present value of cash flows. Understand? What are the present value of cash flows? 25, 25, 25, 25, 25 over 6 years plus last year to 525,000. Understand? All these cash flows should be discounted at the rate of 6%. Then you will get a value of 478,800. What is the face value or the principal value of the bond is 500,000. Difference should be allocated to equity. Then look, this is debt part. This is debt part. This is equity part. This is the total value. Then double entry for this is cash debit 500,000. Equity account credit 21,200. Debt account credit 478,800. Same kind of questions we have done previously. Therefore, I don't want to discuss again and again and again. Understand? There we assume that there is no issue cost. Understand? This is first part. This is first part, huh? In the second part, what question says? Then there is issue cost. Part B, on 1st January 2006, an entity ABC issued a debt instrument with a value of 5 million, incurring 150,000 in issue cost. Then coupon rate of debt is 2.5% and it will become payable on 1st January 2020XY at premium of, look, at a premium of 1750. Tell me what are the finance costs included in this? What is the question? Requirement. Calculate the total amount of finance cost associated with the debt instrument. So what are the finance costs inside this? 5 million into 2.5% interest you have to pay at the end of each year. Then 5 million into 2.5% means 125,000 annually. Over how many years? $10 X6, Y6, you can see, right? 10 years, then over next 10 years, you have to pay 125,000 as interest. Another one, what is at the beginning? There is issue cost of 150,000. Then 125,000 annual interest plus issue cost of 150,000 which is to be incurred at the beginning of the period, plus when you are redeeming this debt instruments at the end of the year, at the end of 10th year, you have to pay extra how much? 1,750, premium of 1,750. Then altogether you have 3 types of finance costs. What are those? At the beginning, issue cost; at the end, premium; over the period, interest. Understand? Then calculate yes, total amount of issue cost. Then that's all I have done already. Look, 5 million into 2.5 or 10 years, 1.25 million. Repayment at the end of the period, 5 million capital plus 1,750 at the end of the period. Then it's 6,750 altogether. What is it? 8 million. Total amount payable 8 million. Right? Total amount received is how much? Not 5 million. 5 million minus issue expense of issue cost of 150,000. It's 4,850. Then what is your finance cost? 3,150. Understand? So its issue cost is 3,150. Can you remember we now if you need to what is called, it is convertible in this case. No, it's not convertible one. Yeah, fine. Then how do you amortize this finance cost? 3,150. You cannot recognize issue cost as an expense to the first year. You can't recognize only this finance cost over the 10 years. You can't recognize premium at the end of the year, end of 10th year as an expense. What you should do? This total one should be amortized gradually over this period, 10 years. Right? We will do that kind of question. I think we have one. Can you remember this question I told you previously? There we did the same. Right? You can remember in this question also we have a discount which is given at the beginning of the year. There is a premium of 1,015 at the end of the period. There is interest over the period. There are 3 types of expenses in this. Not 3, 4 types of expenses we have: discount, premium, issue cost, and interest. Then you can't recognize these in those years. We had to write off it as, if you can remember, I gave you the way of doing this. If you can remember that? Here effective interest rate is given as 12%. Can you remember? If it is not given, I told you how to take this 12%. How to take this 12% if it is not given? That is the most important point people are missing from this questions. I will not able to test it in the exam, but you should understand if it is not given. That is the most practical aspect. What is, how do you find out this effective interest rate of 12%? Huh? 1 divided by e is to the power n, that is present value formula. Not that. You have to find out IRR. Can you remember I told? IRR is the 12%. That means same thing. I can, if you need, I can show you. I did it in the classroom using Excel, and I calculated this 12% rate, and I showed you as the 12% rate comes. Can you remember? At the beginning, how much we get as cash inflow? How much we get? What are the expense? We have 20,000, right? Then what is cost for related? Then in year 0 there is cost of 2,000 discount. Actually, net cash flow at the beginning, or at year 0, how much? Net cash flow in year 0 is 18,000. Then over 4 years you have to pay interest. Over 4 years you have to pay interest, right? At the end of the year, there is at the beginning there is another cash outflow, that is 1,000 issue cost. At the end of the year, there is premium of 1,015 cash outflow. Put all those and find out the IRR. In Excel it's very easy. I did it several times. IR equal IRR, highlight those cell areas, close the bracket and enter. Your rate will be 12%. Right? So that's how they have given the effective interest rate of 12% there. Double entries, everything we did, calculations, if you can remember all these. Right, then look, at the beginning we get only 17%. Why? We had 20%, 20,000. From that we gave a discount of 2,000. We had issue cost of 1,000. At the beginning, the correct liability is 17,000. That's what, if you can remember, we learned something called financial instruments are recognized at the beginning. How? Fair value after deducting issue cost, including issue cost. That's how we learn. Look, after deducting issue cost, we have recognized initial liability of 17,000. This is the way of doing this. You are not allowed to recognize all these expenses when it is incurred to profit and loss account. You have to amortize gradually, step by step over the period. Right. Look, this question. Read this carefully and see. Right now, if this kind of question is given for the examination, how to write an answer? The first question, right, before that we'll see the question, example number 5. You are the management accountant of Short, which means company. On 1st October 20x3, Short issued 10 million rupees 1 preference shares at par, incurring issue cost of 100,000. The dividend payable on the preference shares were fixed at 4% per annum. Fixed at 4% per annum, right? Payable on 30th September each year in arrears. The preference shares were redeemed on 1st October 20x8 at a price of 1.35 per share. The effective finance cost of the preference share was 10%. Why? Because of that redemption premium. It has been increased 10%, right? The statement of financial position of the entity as at 30th September 20x8, the day before redemption of the preference shares, was as follows. Ordinary share capital is given non-redeemable. Redeemable preference shares. Share premium account. Share premium is not applicable in our country. This is kind of foreign question. And retained earnings of this much. Now, question number 1. Look, write a memorandum. It's kind of small note to your assistant, which explains how the total finance cost of the preference share should be allocated to the income statement over their period of issue. Yes, that's what I said previously. Answer I told you from the previous question. What do you need to write as answer for this question, this part A? Yes. What are the points to be included in your answer? At least. Anybody? First point, you have to say whether it is part of debt or part of equity. What is this? What is the most suitable classification given for these preference shares? Is it debt or equity? First, you have to understand. Redeemable preference shares. How to classify? There is fixed dividend component and redeemable. What is that? Part of? That side he says debt, you say equity. Which are? Others? It's part of debt. So that is the first point you need to mention in your answer. Why? You have to say these two conditions are in extreme cases redeemable nature, and this has fixed rate of dividends. So therefore you have to say this is coming under financial instruments, actually financial liability according to IFRS 9. That's first point you have to say. Then what are the costs relating to this? Now look, 10 million shares at 1 rupee they are going to issue. But they will redeem at 1.35 per share. Then the company, look, 10 million rupees 1 preference shares at par they are issuing. At the time of redemption they will pay back how much? 1.35 extra 0.35, 35 cents per share. It means 35 cents into 10 million. What is your what is called extra premium you are going to pay? 350,000. No, 10 million, no? 3.5 million. 10 million shares into 0.35. Means 3.5 million you will pay as premium at the end of the year. Also, over the period of how many years? 3 to 8, 5 years. Over the period of 5 years, you have to pay interest of how much? 10 million into 0.4, 400,000 per month, per annum. Understand? Yeah, 400,000 per annum. Yes, correct, right? Then what are the costs relating to this preferential? What are the costs related to this issue cost of 100,000 at the beginning? Over the 5 years, 400, 400, 400, 400, 400. At the end of the year, at the time of redemption, there is capital repayment of 13.5 million. How do you take 13.5 million? 10 million principal amount plus premium of 0.35. Total 13.5 million you have to repay at the redemption time. If you put into Excel, you take an Excel sheet and beginning you will collect 10 million, not 10 million, 10 million minus 100,000. 10 million minus 100,000 in year 0, put. In year 1 to year 5, how much? 1 to 4, 400,000, 400,000, 400,000, 400,000 minus. In year 5, 13.5 million. Take the IRR, it will be 10%. You just calculate in Excel, it will come. Done. Just see like that. That's how we calculate IRR or effective interest rate. Otherwise, you will not be able to. Now, if it is not given, you should be able to say how to take it. Explain it. No need to calculate in the exam. You can't do all these calculations. No, it takes time. At least you should say that you need to take these cash flows, take IRR, use IRR to discount these cash flows. Otherwise, your answer is wrong. Understand? So you can say, but it takes time. So I'm going to do that in Excel sheet. Hope we have done no need. So we have done it several times during the year. So if you need, you can see those videos. Those are there. No, we did no in Excel. Yes, right. Now that's it. That's the answer. Look, the answer is there. Hope you can't read. No need to read, but look, figures are there. That's what I said previously there in the first part of the answer. But you need to write. Explain it. How to recognize it? I explain like you have to write it. Total payables 13.5 million. Look, plus expense of 2 million. Total finance cost is 15.5 million. Right? So then this is interest over the period 2 million, and also issue cost. Net proceed 10 million minus 100,000 is 9.9 million. Then total finance cost is 5.6 million. Got it? How to get 5.6? Very simple. No? 2 million interest over 5 years, 400,000 into 5. Redemption 3.5 million extra, then 5.5 million plus issue cost of 0.1 million means 100,000. Then altogether it will be 5.6 million issue cost. How do you amortize it over the period of 5 years? It is not tested directly in this exam question, but you should say. What was the question? Calculate the finance cost in respect of the preference shares for each of not beginning. They ask what is finance cost for each year for next 5 years. Tell me now with this, what is finance cost for the year 1 with these facts. Now answer also there. Tell me what is finance cost that you charge to profit and loss account. How much? Do you charge issue cost and interest both for the first year? That's what I told you up to now. You should not do so. You take total finance cost of the debt instrument and amortize it over the period. Otherwise, what will happen? This premium you will charge to the last year as an expense. It is wrong. Don't do that. It is wrong. But you had the debt instrument over 5 years. Charge it over 5 years. What is finance cost? Tell me, what is my total liability at the beginning of the year? Double entry wise. What is my total finance cost at the beginning of the year? Yes? Anybody? What is my original double entry that should I pass at the time of issuing? How much we get cash in hand when we issue these preference shares? ඔය බැරි නම් ඉතින් ෆයිනෑන්ෂල් ඉන්ස්ට්‍රුමන්ට්ස් ඉගෙන ගන්න නැහැ ඇත්තට. පරණ ස්ලයිඩ්ස් කියවලා නැහැ. ඒකයි ඒක හේතු තේරුම. Here, how much you get cash in hand when you issue preference shares? 9.9 million. Why? You have 10 million, but from 10 million you have to spend 0.1 million for what? Issue cost. You have to spend that money at the time of issuing. That's why theory said in financial instruments, IFRS 9, financial instruments less issue cost. You have to recognize. Usually what we know now, when let's say if you are going to get a bank loan, if there is any what is called lawyers fees and everything, what we do usually, we recognize it as an expense. It is wrong. We should not do so. Not that. In inland revenue, how to check that? So we should not recognize. I don't know what is the guidance given by the Inland Revenue Act, this kind of related to this kind of artificially amortized expenses. You have to add back, no? Ekala? You have to subtract the amount you paid, real interest, actual interest. Yes, right? In that case, what happens when it comes to Inland Revenue, the tax purpose, we will have big issue cost beginning. Over next 3 years, less. Again, finally, it will be high. Is it? For tax purpose. I don't know, I'm not tax expert. As I know. How it happens? Tax minister tax done because tax done. Right, then initial double entry is 9.9 million cash or bank or whatever thing debit. Credit to financial liability 9.9 million. Then what will happen? You have to compound it at the rate of 10%. Also, you have to make payment, cash outflow of 400. When you pay 400, what is double entry? Cash credit, because annual interest you have to pay, no? Cash credit, liability account debit. You can't charge that one into profit and loss account. It is not the amount you need to charge profit and loss account. Then beginning liability balance. Yes. Draw an account. Beginning balance 9.9 million. I'll put it in millions. Right? Then first year cash payment of how much? Cash you pay 0.4 million. What is that? You pay interest. For this 9.9 million, you have to calculate compound finance cost at effective interest rate of 10%. You pay that with what percent? This is at 4%. Right? But you have to charge to profit and loss account 9.9 million into 10% means 0.99. This goes to where? Look, profit and loss account. At the end of the first year, what is outstanding balance? 9.9, 9.9 plus 0.99 minus 0.04, it's 10.49. At the end of the year 1, your closing balance will be 10.49. That is there in the table even. Then you brought forward it to the next year. Compound interest for the next year for the same, that into 0.1%, it's 1.049 interest. You charge it to profit and loss account. You pay cash point, how much? 0.4 million, 400,000. Likewise, you continue your what is called account for 5 years. Finally, you see, this is there. This is interest you charge to profit and loss account. Finally, what will happen? Your total finance cost will be equal to 5,600. Then final balance at the end of the year, your closing balance will be 13,500. Right? If I calculate it, it will take time, otherwise I'll do it. I'll do it quickly because figures are here. No? This is the account presentation. 11.139. Then brought forward 11.139. Next year interest will be 1.114. It goes to profit and loss account. You pay cash how much? 0.4. Carry it down. Then now 3 years completed. This year brought forward balance will be 11.853. Then again you charged something to profit and loss account. It's 1.185. Then again brought forward. Here cash 0.4. Now 1, 2, 3, 4. Last year, look, 12,638 will be outstanding balance. From that, you charge interest 1,262. It's around 64 because of this decimal impact, right? 1.262. Then at the end of the year, look, now I have balance of, I'll pay how much? 400 as interest for this year. At the end of the year, look now, 12,638 plus 1,662, it's 13,900 balance. 400 interest you have to pay, and balance exactly you have to pay how much? Look, cash, when you redeem this preference shares, how much you need to pay as promised? How much? 13.5 million. Then account will be closed. Look, what are the amounts we have charged to profit and loss account finally? First year 0.99, second year 1.04, third year 1.14, fourth year 1.185, fifth year 1.1262. We have charged profit and loss account as interest. That's what we call amortization of interest over what? Over the preference share period. Understand? Right. If there is anything more, we do it in the exam. All right. same kind of thing you should be able to do it. For financial instruments, I think it is enough. I need to do the next also. We have 30 minutes. It's about this. IAS 19 for employee benefits. What are the 4 types of employee benefit? What is the main concept behind this? What is the main accounting concept behind this? Anybody who can say? I told this. What is the main purpose behind this standard? We need to recognize actual amount of employment cost of a business. To comply with what concept? What is the concept? Matching concept. We use our labor to produce income. We should take relevant expense into profit and loss account. Mostly we don't do. Very simple example, let's say, in my mind I have a plan to resign from my business at the end of, let's say, next year. Or even this year. This year end I am planning to resign from the business. I am the, let's say, senior manager. Then you are my subordinates. What I do? I'll give you simple encouraging thought to you. This year end, if you work hard, so we will give you a commission as a kind of bonus or something based on the last number of years service that you have worked and 60% of your salary. So I can say like that, no, if I am the only person in the head of that particular division, or the company. So then what happens? After we know this kind of promise, what will happen from tomorrow onwards? Maybe either way. Mostly people will work, they are motivated. But as a result of that, what happens? My income will be increased. So then if I don't provide any kind of cost relating to my promise given to employees, I'm not complying with matching. I have given a promise, but it has a kind of cost. Because if I achieve that level, I have to pay something at the end of the year. If so, I'll recognize it as an expense for the next year. But it is wrong. Why? You produce income for this year because of this encouraging package. But I'll recognize expense in next year when I pay. It is wrong. So that's why they say to comply with matching, take relevant expense to profit and loss account relating to employment of its employers. What are the types of benefits we discuss in this standard, IAS 19? What are the types of benefits? There are more main 4. What are those? Yes? Short employment benefits. Termination benefit, other long-term benefits, and post-employment benefit. Then what is short-term benefits like salaries, wages, etc.? You have to charge it in to profit and loss account once it is incurred on accrual basis. We know it. No need to learn it here. Termination benefit, if employment is terminated by if employee's employment is terminated by employer, what will happen? Employer will pay kind of compensation. Oh, we call it retirement money. Not retirement money, termination money. It should be recognized as an expense for the terminated year. But if the termination money is paid over a certain number of years, take the present value and recognize as an expense. That's how theory says. Then other long-term benefits like sabbatical leave, I told you. There are some employment benefits provided by employer to employee as a result of long-term employment. Like in our case, I told you, when we work as senior, the confirmation post for 7 years, 8th year we can have sabbatical leave. Then we can work outside, but I can earn university salary as well as outside salary. Again, after 1 year, I have to come back and serve for the university. What is that? It's time of long-term benefit. Why? Benefit is given for 1 year, but it was given as a result of long-term service. We call them other long-term benefits. That other long-term benefit should be recognized as an expense to employer over the employment period of employee. So that's how we learn. The last one we learn, post-employment benefit. there are some benefits provided by employer to employee after employee's employment period. That employee will not come back again. Sometimes employee will stay at home after the retirement, they will not come. After retirement also some benefits are given by employer to employee. Those type of benefits we call post-employment benefits, and we classified into two. What are those? Two types. Now, defined contribution plan and defined benefit plan. So then in defined contribution plan, contribution is defined but the benefit is not defined. In that case, you have to recognize it as an expense on accrual basis. But defined contribution plan, made mistake. Defined benefit plan, if any promise is given by employer to employee, we have to develop a fund or generate a fund to meet the liability of employee at the end of the period. Understand? That fund should be maintained with a third party. We call them actuaries, a fund management company, and those values will be given by actuary. Right? Those are things we learn. So there, it was a major one we learned. You can remember, we have to go to that level. 4 types of employment benefits: short term, other long term, sabbatical termination benefit, and post-employment benefits. These are in 2 forms: defined contribution plan and defined benefit plan. Look. In defined contribution plan, I told you you have to recognize it as an expense for the incurred year. If there is any balance, you have to recognize it as a liability. In defined benefit plan, know that separate plan should be established by the employer on behalf of employees to meet the liability to settle at the end of the retirement. That fund should be maintained in a separate, with a separate party, third party. The standard says there is a method called projected unit credit method to recognize it as an expense, a liability asset. Accordingly, if any employee is working for 1 year, his contribution, retirement money will be increased by a certain amount. That amount we call, what is it? What's the term we use for that? If any employee is working for a company 1 year, his pension fund will be increased by some amount. Present value of that is known as look, this chart shows when you work for 1 year here, when you work 1 year here, what happens? When your pension fund will be increased by a certain amount. Take the present value of the same. That value is known as, there is a term. මොකද කියන්නේ අපි ඒකට? මතක නැහැ නේ මොකෝ. කන්නේ මොනවා? වචනේවත් මතක නැද්ද වෙනිස් එක්සෑම්? දැන් පාඩම් කරන්නේද ලෑස්ති වෙන්න පොඩ්ඩක්. කියවලා රෙඩි වෙන්න. ඔන්න ඕපන් බුක් වගේ නම් කමන්නේ. Or we'll keep it as open book. I like. If it is open book, I don't repeat any question given in the class or even in tudes or whatever thing. So if you like, you just propose. I'll get the permission from coordinators to give open book text. You can bring whatever the material you need. So what do you think? Is it good? What again? I am ready. If you are ready. ඕන ලෝකේ තියෙන ඕන පොතක් අරන් ඉන්න පුළුවන්. කිසි ප්‍රශ්නයක් නැහැ. But I don't repeat anything like this. Then fully fresh questions. එහෙමත් මම කැමති මම ඇත්තටම ඉස්සෙල්ලත් ඔය හිතුවා. අපි මම අමාරු වෙන්නොත් එමේ අන්තිමට දැන් පන්තියේ දෙන එකකුත් ලියන්න නැතුව අලුතෙන් එකක් දුන්නොත් මොන ලෝකෙන්ද හොයලා ලියන්නද පොත් ගෙනාවට නැද්ද? Right, anyway, let's see, right? No, there are people who scored well, right? For the last exam also there were no. හොඳට ලකුණු ගත්තා හිටිය අතන, right? There were extreme cases also there, that's a question. But anyway, there were people, they scored very well. 80, 19 ගත්තා හිටිය මට මතකයි 86 ඔක ගත්තා එක්කනොත් හිටියා. 86 හරි 87 හරි last time from your batch. Can accounting paper එක. Last time කියන්නේ last year නෙමෙයි. ඕගොල්ලෝ batch එකේ accounting paper එකට. Last semester. Therefore you can do, but just see this, right? What I was talking about? Yeah. If any employee is working for a year, his pension fund will be increased by a certain amount if it is paid on a firm formula. That the present value of the same we call current service cost. මතක නැහැ කාටවත් නේද? Current, look, current service cost should be recognized as an expense. If you can remember, I told you only 5 double entries to remember, because all these figures will be given in the exam. You have to put these into accounts. What's double entry for current service cost? Profit and loss account or current service cost debit, liability account credit. The next entry we learn compound interest. If you take something in present value terms, every time I told you in accounts, to meet the liability, what you need to compound it for the future. So then compound interest on the same, on the liability, to the liability, like in the previous question also, can you remember? For the debenture, preference share 9.9 million, we compounded to meet the liability. That is what we call compound interest. So then that addition of interest, you have to recognize as expense and addition to liability. Then profit and loss account debit, liability account credit. Then third entry, according to the standard, we need to keep aside our liquid assets with a third party to meet the liability to be paid at the end of the period to its employees at the time of retirement. So then when we send money or liquid assets to the fund, double entry, when you say like when you send money for EPF, ETF fund or something like that, cash or bank credit, my fund or the plan asset account debit. Then what they do on behalf of me, my money will be invested somewhere and they will give a return to me. Third party, fund management company, they will invest it and give a return to me. So that double entry, we call it return on plan asset. Asset account, they don't give it by cash, but they will credit it to my account. So then plan asset value will be increased. Plan asset account debit, income statement or interest income account credit. Finally, fifth entry, when my employees are retiring from my business, they will pay what? Retirement money. So then double entry, one side my plan asset goes down, on the other side my liability goes down, liability to employees goes down. So therefore liability account debit and asset account credit. Those are the 5 entries you have to remember to manage this question. It's very simple, right? Shall we look at one? Look, this is a picture. It has everything. ඔය ඉතින් අපි කරපු workings උත් තියෙනවා. කාටවත් කියන්න බෑ මේ කරේ නැහැ එහෙම කියන්න බෑ. because those are there. Right? Workings are there. Right? Yeah, save those. So look, increase in annual pension payment, we take the present value, then we call it current service cost, debit to current service cost and credit to liability or value or present value obligation. Same thing we compound for the future. So then interest or P&L debit, income statement debit, liability account credit. Then look, we have to keep aside some money, that's what we call here. Plan asset account debit, cash or bank credit, and it will grow up. When you grow, plan asset account debit, expect a return, income statement credit. And one entry, it is not there. When the third party or fund management company will pay money to my employees at the time of their retirement, so double entry, liability account debit, asset account credit. Right. With that, you should be able to do this question. These are the questions we did. Look, these kind of questions already we have discussed, therefore no need. Same thing we have discussed, no? We can move to share-based transaction if so. This is kind of question we have discussed already. Hope no need, no? When it comes to statement of, in the exam you have to be careful what are the items you need to show as asset, liability, income, expenditure in financial statements from this. Current service cost, yeah, profit and loss account expense. Interest expense, profit and loss account. Interest income, profit and loss account credit. You can take net of that too. Net interest on employee benefits plan, you can take into profit and loss account. Also asset liability, plan asset, plan liability. All these asset liability values will be given by whom? Look, these closing balances are given by actuary. They will assess what amount of balance should be available in my account to pay the liability at the end of the retirement. So based on that, I will do adjustment. There will be a difference inside these plan asset account and plan liability account. That difference we call plan asset plan liability account එකේ තියෙන account එක වැහුවාම තියෙන difference එක. What is that? We call it actuarial gain or loss. It depends, right? Net of these two we call actuarial gain or loss. We have to put that. No, yeah. It goes to other comprehensive income. Can you remember? One item that we need to record into other comprehensive income is actuarial gain or loss. You go and see L case number 1. Those are there. It comes from this standard. Actuarial loss or gain should be recognized as part of other comprehensive income. And one more, asset and liability, net asset liability difference, you have to recognize as part of asset to liability in the balance sheet. Those are the items you need to record in your financial statements. Therefore, if you have this kind of question, finally you have to tell what kind of balances are taken into profit and loss account and what kind of balances are shown in your statement of financial position. All right. Shall look at this quickly, then this will be finished. What is this? Share-based transaction. This is very simple. Some companies will pay kind of bonus, or you can say not bonus, kind of motivational money to its senior employment based on share price increments. This is very common practice in other countries and multinational companies here. So therefore, what will happen? Let's say now I am giving these are my senior 2 managers. So they are the people who are running the business. Then I give a target like this. Let's say now today my share price is, my company share price, let's say 50 rupees. I give a target to you. You try to work hard and bring new ideas to the company and add some value to the company, show performance. As a result of that, what happens? My share price will be increased. I give you a target. Within next year, if you increase my share price from 50 to 60, now current price is 50. If you can increase it to 60%, made mistake, 60 rupees. So then I'll give you 1 million rupees. So then what do you have to do? You have to work hard to increase price. How it happens? You have to work hard, you bring new things, do different kind of things in the market, get kind of good image to the business as a result, show good performance as a result of that. What happens? People will demand more for my shares as a result of that. What happens? My share price will be increased. If you don't work hard, if you sleep whole day, what happens? Day by day, my share price will come down. We assume there that performance will be a good reflection of made a mistake. Share price will be a good reflection of my performance of the company. In practice, in our country, what happens? It is not so. That's the reality, right? Most of the companies, what happens? Even though they are running well, sometimes come down. The poor performing companies, prices are going up. It means some other factors are having the big impact than the performance. That's the meaning. So when one senior manager or senior senior person is shifting from one company to another, what happens? Even though it is performing bad, its share price is increasing, having kind of big hope in the future. We have seen in the market, when one company is acquiring another, the big company is acquiring another, sometimes share price of both are increasing. When government is making a big different change, the decision, share price is coming down in some sector, some companies, some going up. Let's say if government is going to take crucial decision, people who are having contacts with the government, those companies, share price is increasing even though performance is not there. People think it a different way, but it's kind of main drawback in this IFRS asset, right? So then basically these type of payments we classified into 2. How? I can give you the same story like this. I can tell you if you work hard and increase my share price from 50 rupees to 60 rupees, I'll give 1 million. We call that kind of packages cash settled share based transactions. Or what I can tell you, another option, if you increase like that, I'll give you 10,000 shares at 50 rupees. Then what is your benefit? I'll give you 10,000 shares at 50 rupees. If you work hard and increase my share price to 60, what will happen? You take that 10,000 shares and sell it at the market for 60 and get a gain of 10 rupees per share. That sort of things we call equity settled share based transaction. Or maybe some other combination. What's that? You work hard and increase my share price from 50 to 60. If you need, you can have cash, or if you need, you can have shares. That means option is given to employee to decide. Then there are major three types. One, cash settled share based transaction, equity settled share based transaction, mix of that two. Understand? In cash settled transaction, so even though the cash payment is made in next year, I should not recognize it as an expense for the next year. I should recognize it as an expense for the current year. Again, imagine concept. Why? This employee worked hard within this year to increase my share price. As a result of that, he is allowed to get a gain, but gain will be given next year. But it should not be recognized as expense for the next year, it should be recognized as expense for this year. So therefore, we made a provision. What is the double entry? In cash settled share based transaction, if I give a promise like that, let's say, if you work hard and increase my share price from 50 to 60, I'll give 1 million. When I give the promise, I should pass a double entry. What's the double entry? Profit and loss account, debit, liability account, credit. Understand? That's what we call cash settled share based transaction. If you get the cash, what happens? Cash credit, the liability account debit. Otherwise, let's say share price came down 49. Do I pay? No, I don't pay. Then what I have to do? Should be reversed. Understand? Right. Other one is equity settled share based transaction. What's double entry? Debit, let's say like this. If you work hard, I'll give you 10,000 shares. 10,000 shares. I have to take transaction date price at the beginning of the year. Let's say market price currently 50. So then I am planning to give 10,000 shares at 50. Then 10,000 shares at 50 means 500,000. So then 500,000 debit to income statement and credit to equity account, right? So then if I give shares at the end of the period, equity account debit, my share capital account credit. If I don't give, reverse it. Let's say you are not allowed to meet the condition. As a result of your work, share price came down. So then I don't give shares. Then what will happen? So then nothing. Then reverse the entry. Understand? So that's what we call in IFRS 2 as share based transaction. So those are there. Equity settled and cash settled transactions. I told some several points. All these based on estimates. I told you, right? At the end of the first year, let's say this share based transaction is running for 5 years. At the end of the year 1, I don't know how much of employees will get the claim. I don't know whether you will retain with me at the end of the period. I don't know whether you will achieve the target. But all these are based on certain assumptions, right? So that's how we learn. Several times I tested this question to ask some merits and demerits of IFRS 2, share-based transactions. I discussed all these. Every time what I feel, we should recognize this expense to profit and loss account to comply with matching concept. Also, if it is given by employer, it's part of employment income. That's how you define it. So therefore, what we need to do, we have to recognize it as an expense. Also, to calculate or measure the real management capacity, we need to take those as an expense. Otherwise, the future managers will have to pay compensation on that. Also, there are some arguments against this. One is, let's say now, if I give a package like this, I say now, I'll give you free shares, free 10,000 shares if you meet the condition of from 50 to 60 increase of share price. My current share price is 50. If you work hard and increase my share price to 60, I'll give you 10,000 shares free of charge. I don't get cash. So then, is there any cost to me? No cost to me. I give only 10,000 shares. Then you go to market and sell it and get a gain. Understand? If you can increase share price further, what will happen? Your gain will be further increased. Understand? So therefore, in that kind of case, I don't have any cost, but I recognize it as an expense. When it comes to expense definition in framework, what happens? There should be economic outflow, but I don't have any economic outflow. There is kind of violation there. Even though employer recognizes that kind of outflows as an expense, expense definition is not met. The another interesting impact is, I told you when company is performing well, what should happen? My earning per share should be increase or decrease. When you are performing well, my EPS should be increase. But look what happens if you have this kind of things. If I give you free shares, 10,000 shares, if you meet the condition, my condition, you have to increase my share price from 50 to 60. If you increase, I will give 10,000 shares free of charge. Understand? So then you will get that shares and go to market and sell it. As a result of that, what happens? If I recognize it as an expense, my expense goes up. Expense goes up means profit goes down. On the other hand, my number of shares will be increased. As a result of that, what happens to EPS? EPS come down twice. Look, profit after tax goes down, artificial expense is recognized profit and loss account. On the other hand, my number of shares, the denominator and numerator, look, goes up because I have given free of shares, free shares. As a result of that, what happens? EPS hit twice. It comes down twice. It is kind of bad impression for the company. Look, finally what has happened? Employees work hard, good performance, everything is okay. My EPS comes down. It is not good. So those are kind of arguments against IFRS 2. Hope with this, enough, no? So we have completed those things. I think I did several questions. Then you just see these. And next week we do some questions from IFRIX and group financial statements. Right? Any clarification or question? Right, then we have classes only for next Saturday, I think. Yes, no? But we'll see next Saturday we will have class. Then with that we will finish everything. I'll do some questions for company accounting, plus I'll do some past paper questions. I need to discuss at least one paper, 2013 paper probably. I'll discuss in next class. Then remember, when is exam? 1st of April. Very good day. Yes. හරියටම coordinators ලා කල්පනා කරලා ඇත්තනම දාලා තියෙනවා date එක. Right? April 1st. Examination starting date or the accounting? Starting date. Very good. Right? What is the first subject? Strategic management. Okay, then all the very best for the exam, and anyway we will have another session next week. From tomorrow you will wind up all others, no? Others, 3 subjects will be finished, no? By tomorrow. Then we will have another 3 subjects. Okay. With that you are going to complete your master's also, no? Yes, good. If you are not coming for the second year, you can finish it. Right. Be careful when you do the research part. I have seen that people are struggling with that component, not like subjects that you do. Also remember to submit your assignment. Like last time, don't ask any excuses.